There are generally three areas for mobile banking regulation that need to be considered. First, there is Know Your Customer regulation. The idea is that by knowing your customer well, a mobile banking platform operator could reduce identity theft and money laundering. Making sure that the person who will send or receive payments is the person they say they are can be done in various ways, now including fingerprints, retina verification, facial recognition, and basic signatures. Even in remote areas without electricity, identities can be verified. Having lower limits on the amounts of money that can be transacted without a lot of regulation to check identities is a good starting point. It would take a lot of effort to move large sums of money by a money launderer if the limits were quite low, and most remittances are relatively small sums. As the limits are raised, then the amount of information required by the transactors could be increased commensurately. Another element of fraud detection is to ensure the cash-in, cash-out, or Chico agents are legitimate. How are the Chico agents checked to make sure they are distributing the money appropriately? Are there courses or licensing tests for the Chico agents to ensure they know what acceptable behavior is and the consequences of cheating? Such licensing tests and follow-up checks are advisable to ensure the Chico agents do not act fraudulently. Second, what about contract enforcement? Having a consumer protection site or a place for people to go to report when they have lost money or when they feel their contracted services were not provided as they thought is also an important component to consumer protection. The World Bank has a set of consumer protection guidelines as part of their World Bank's Global Survey on Consumer Protection and Financial Literacy to help policymakers navigate this element of the financial system. Third, what are reasonable costs? How can one tell when price gouging is present? Gathering evidence and proving prices are extraordinarily high is not so simple, especially if the mobile phone company is dominant or is a monopoly, or if the banking system is equally highly concentrated. The telecommunications industry used to be viewed as a natural monopoly due to the high fixed cost of telephone lines and other infrastructure of starting it. Once the infrastructure is in place, many people can use it at low cost per unit, or in this case, per telephone call. These two features, high fixed cost and low variable costs, characterize a natural monopoly, usually requiring regulation to ensure customers aren't overcharged after the fixed costs have been recovered. In some cases, this has led to a dominant mobile phone company. Even without the high physical fixed cost, there are still fixed costs needed to set up electronic networks, and there are high initial programming costs. So price gouging could still be an issue. Even if difficult, very high prices can be detected by looking at comparable countries' costs of their systems, asking for detailed cost data from the companies themselves, both banks and telecommunication providers, and comparing them to existing non-mobile payment costs.